A common question is, how do we reduce the taxes we pay on our required minimum distribution? And in today's video, I'm going to walk you through a strategy that we utilize with clients to help them potentially reduce the taxes on those RMDs by hundreds to thousands of dollars. For those that I haven't met, I'm Scott Sierens. I run a retirement planning firm where we partner with families and individuals to help them minimize their taxes, make work optional, and invest with confidence. So if you own an IRA, SEP IRA, simple IRA, at age 72, you have to start taking those required minimum distributions or forced income that you need to take out of the account to make and meet IRS requirements. And every dollar that comes out of those accounts is going to get taxed at your ordinary income tax rate. And so today I'm going to walk you through a strategy called the Qualified Charitable Distribution, or QCD, and we're going to talk about how you can utilize that strategy to reduce or minimize the tax on your RMD. A lot of times I get questions from clients to say, okay, well, we don't necessarily need all of our required minimum distribution, so could we just let it in there? And the answer is no. We have to take that money out to meet IRS requirements, otherwise you're going to get penalized. So the other question then is, well, if we have to take it out, we're going to pay tax on it, how do we reduce that tax? Today we're going to walk you through that example of utilizing charitable contributions to reduce that tax on your RMD. So for the example that we're going to utilize today, let's just say that a person has a required minimum distribution that they need to take of $50,000. And let's also say in our example that they, throughout the year, give $10,000 to different charitable organizations. So how can we utilize these charitable contributions to reduce the tax on the required distributions? And I know what you might be thinking, because typically people pay their, or not pay, but donate to charity through checks that they might write through their checking account. And in the past, the standard deduction, or currently the standard deduction, is so high that while you're doing a great thing by donating to the charity, you're not necessarily able to write off or itemize any longer those charitable contributions. And today we're going to talk about how to get the best of both worlds. But let's first walk through I'll call it the old process, or how you might be taking a look at things today and not being able to get the benefit of both worlds. So you've got your IRA, and again, you have to take that $50,000 RMD, and where do we typically bring that? We bring that right to our checking account. And as we talked, we have to pay tax when we take those RMDs out of our IRA. And then from there, if you're giving to a charitable organization, out of your checking account, let's say, then you're writing that $10,000 worth of charitable donations to the charity. And as I had mentioned, based on standard deductions right now, a lot of times you're not able to itemize those charitable contributions. Now, starting at age 72, when you have to take your required minimum distributions, there's another way to go about this, and it's called the Qualified Charitable Distribution, or QCD. So we're going to use the exact same numbers, we're just going to do things in a different fashion. So what if instead we use the QCD process, where you're giving money directly from your IRA to the charity? So instead of bringing it to your checking account first, you're going to give it directly to the charity. So from the IRA to the charity, the same $10,000, but instead we're using the QCD process. You see, by doing this, it now reduces the amount of required minimum distribution that you need to take by $10,000. So the IRA, the RMD that we now need to take out of the IRA is $40,000. That's what goes to your checking account, and that's the amount that you now pay tax on. So let's just take this a little bit further. Let's just say you happen to be in the 22% bracket. Well, doing this the old way, 22% on that $50,000, that would be an $11,000 tax bill. However, utilizing the QCD process, 22% on $40,000, that's now an $8,800 tax bill. So as you can see right there, $2,200 in tax savings just in our example here by utilizing the Qualified Charitable Distribution strategy. Now, as always, there's different IRS guidelines and requirements when it comes to these different strategies to utilize. So speak with a financial professional as well as your tax preparer to make sure that you're doing this in the proper manner. A few of the requirements: you must be age 70 and a half to utilize the Qualified Charitable Distribution strategy. The max amount that you can do is $100,000. And you know, just because I put $10,000 on the screen here, you can give any amount that you so choose as long as your custodian allows you to do so. So you could do a $25 check here, $100 check here, $1,000 check there. It's all up to you and what you'd like to give. As you can see, it's the overall benefit of it reducing the amount of income that you'll actually pay tax on. And the other thing to think about here is not only did it reduce your taxable income, in addition to this, you'll still get the standard deduction when it comes to your taxes. So you get really the best of three worlds. You're doing a great thing by giving to a charity. You've reduced now your taxable income for your RMD, and you still get the rather large standard deduction when it comes to your taxes. The other thing is that you can only do this from IRAs, SEP IRAs, simple IRAs. So if you have your money in your 401k and for some reason you're thinking about leaving it there, this could be a really good reason why you might want to roll your 401k over into an IRA. I hope that you've enjoyed this video and found it to be of value and benefit. And if so, give it a thumbs up, hit that like button. Also, subscribe to our channel. That way you get notified as we're going to come out with additional videos to help you minimize your taxes and retire with confidence.